Alrighty, well, we appreciate everyone for joining us today. This is our quick webinar on the IRS 6055 and 6056 reporting. This is something fairly new for this year that the IRS has created due to the Affordable Care Act. This is the two codes the IRS is using to look for the individual mandate and the employer shared mandate. What we're going to do is just run through a few things today. Big disclaimer before we get started. We are an insurance brokerage. We're not tax professionals or accountants, so know that any information we provide in this webinar is for educational purposes only. It's not legal advice, tax advice, anything along those lines. Make sure after you've got the information from us that we've dug around for, you consult with your accountant or tax professional just to make sure that you guys are doing the best course of action for your business. So what we're going to go over today, we're going to discuss the different reporting requirements of the 6055 and 6056, what the forms are, and what the due dates are. We're then going to look at the 6056 offerage of coverage codes, the 6056 safe harbor codes, and the Q&A section. And that B and C section are really going to be the two hardest sections. And I see we have someone who just joined us. So just a quick recap and repeat. At the top of your screen when you get logged in, you'll see a little button that will allow you to get to the chat box. If you have any questions or concerns, feel free to throw them right into the chat box. I'll keep an eye on that and monitor that as we go along. That way I'll be able to see and hopefully answer questions throughout the presentation. We will also have a Q&A session at the end so that we can go over any questions that you have. So I'm going to go ahead and just dive right in. And of course, everyone is currently muted. I have this in a lecture mode, and we'll kind of go from there. So what in the world is 6055? What 6055 is the IRS code for the individual mandate under the Affordable Care Act. This is the requirement that the IRS is using to determine whether or not someone had coverage, had qualifying coverage, and owes a tax penalty. The two forms that go with this particular code are Forms 1094B and 1095B. These are forms that have to be filled out and sent to the IRS for anyone who was covered under a health care plan for any months in 2015. So even if you've got employees who were only covered for 3 months in 2015, these forms will have to be done and sent over. They show the IRS exactly what number of months the individual had coverage, and if that coverage provided minimal essential coverage. And there are 10 different things that are required, such as emergency care, prescription drug care, things of that nature, that the Affordable Care Act requires in order for a plan to be considered minimal essential coverage. Thankfully, with us as your broker, we have made sure that every single one of your plans falls under MEC. So that way, you don't potentially have an employee who picks a plan that does not consider minimum essential coverage. One big thing on this, the Forms 1094B and 1095B, if you have a fully insured plan, so you're with Blue Cross, you're with United Health, Aetna, one of those kind of big insurance carriers, you're not paying reinsurance premiums or anything along those lines, these forms are being filled out by the insurance carrier. They're being mailed directly to the employees and to the IRS on your behalf. Under Section 6055, you really don't have much you have to do as the employer. Anyone have any questions so far on 6055? And again, at the top, you should see the little arrow pointing up, pointing down. Click on that, and you'll be able to get to the chat box and pop in any messages or any questions that you have for me. And I see we had someone just join in on the phone. So once again, at the top of the screen, you should see a little arrow. If you click on that, that'll bring up your chat box. So if you have any questions, go ahead and just put it right in there. And I apologize for the folks that have been here already and have heard this a few times already. Put any questions in the chat box, and we'll go from there. I'm going to go ahead and move on to the 6056 now. Again, on 6055, you're really not going to be... And the question I have, so we are covered by UHC, United Healthcare. They will send the proper paperwork to the employees. The employee completes it and sends it back to them. That is correct under Section 6055. The 1094B and 1095B are being sent directly to the employee and to the IRS. And actually, it's nothing the employee needs to complete. All the information is going to be pre-filled out for them. They'll use it to file their taxes. If they, and I should clarify that, quantify that, your employee will need this form if they had a lapse in coverage for any months, so they know exactly what months were reported. If the employee had coverage for all 12 months, they'll be able to do their taxes without these forms, no problem. Any other questions so far? All right, I'm going to go ahead and move forward. So the form on your screen right now is a 1094B form. This is basically just a cover sheet for the IRS. This is what the fully insured carrier is going to send on your behalf. It just has basically the name of the person at the insurance company who's going to take care of this for you, how many forms are being sent, and when they're sending them. The 1095B form shows our covered individuals, who the employer was, and how many months those folks were actually covered. So this is all being done by your insurance company, unless you're self-funded, and we'll get into that in just a moment, and sent directly to the IRS. You'll have nothing to do with these. You won't have to worry about these at all. So 6056. Now this reporting is going to be required for any group that has a self-funded plan or is above 50 members in size. And by 50 members, we mean 50 full-time equivalents. And full-time equivalents are the calculation you do through the IRS that decides how many employees that you have. If you already know that you have more than 50 full-time employees on your own, it's not something you'll have to do. You'll be fine without having to do this. Under the 6056, this is the reporting that is used for the employer mandate. So this is what the IRS is going to use to decide whether or not your coverage is considered affordable. Coverage guidelines for the IRS for 2015 were 9.5% of the gross household income. For almost all of our groups, we have made sure that your coverage fits within that requirement. So if you're charging $20 a pay period for your employees, or you're giving them their employee-only coverage for free, you fit within this guideline. This does not take into account employee plus spouse coverage, employee plus dependents, or employee plus family. It only looks at the employee-only coverage. Now the 6056 reporting, so we said anyone with 50 full-time equivalent employees or more, or self-funded plan, this requires Forms 1094C and 1095C. Now, if you're required to report under IRS Code 6056, you don't need to send both the B and the C forms. So if you have a self-funded plan, then you can send just the C forms, and it covers both the 6055 and the 6056 requirements. So that's why, as an employer, the 6055 is not really something that you're going to be using, because if you needed to send that out because your insurance company didn't, you would get it under the 6056. Any questions so far? All right, I'm going to continue on forward then. So these particular forms, how do they get filled out? The 1094C form is a transmittal form. Your information goes into the top and how many of these forms you're sending. Now, one big thing to keep in mind, if you are submitting 250 forms or more of the 1095Cs, it has to be done electronically. Now, additionally on that 1095C form, there's 4 separate sections. Parts 2 and Part 3 are the 2 big ones. They have all of the codes and all of the information of who was actually covered by the plans. And the other big side of this, these forms are due back to the IRS by February 29, 2016, or March 31st if you're filing electronically. Any questions on the due dates or what these forms have on them? And we're going to take a look at the forms, and we're going to get into more detail on them here shortly. this is the 1094-C form. This form is, again, just a transmittal form. Part 1 is the applicable large employer member, or ALS, many have come to call it. And that's just your employer name. So that's your company information, and the person to contact on the medical plan. This is the same information you will fill out if you have a self-funded plan and have less than 50 members. Below that is your member information and how many forms are being filed. If you're part of an aggregated group, and an aggregated group is going to be someone who has controlling interest in multiple companies. So we look at school districts for this. You may have one school district that has 25, 30, 40, 50 schools. Each school, if the district is not filing these, each school can file these individually, but they just have to put in here that they're part of an aggregated group. And then Section 22 there, certifications of eligibility, qualifying offer method, transition relief, 4980H relief, or 98% offer method. We're going to get into those here in just a moment because each one has a specific way that they get figured out in order to be checked. Any questions on the 1094-C form? This is by far the easier of the two forms that we have to fill out for the 6056 requirements. All right, I'm going to move on to the 1095-C. This is where things get a little more complicated. Part 1 is the easy part. That's the employee. You just fill out that information for your employee, go from there. Part 2 is the offer of coverage and the plan's start month. So the start month is the day that your plan actually begins for the employees. For most folks, you're going to go ahead and just put in January 1. A lot of our groups have a July 1 start date, so you can go ahead and put that in there, and it's the July 1 to June 31st. The employee offer and coverage. Part 2 there, Section 14, we're going to look at those codes here in just a moment. Section 15, employee share of the lowest cost monthly premium. So what you're going to put in there is how much you're charging your employees per month for employee-only coverage. It does not matter if the employee has family coverage, spousal coverage, employee plus children. The only thing the IRS wants in here is the cost of the employee-only plan. And if you provide self-insured coverage, you're in the fire pool through EMI, you have self-coverage through Assurant, Starmark, Trustmark, any of those kinds of companies. Part 3 is where you're going to put in each individual covered person. So if it's the employee plus 3 kids and their spouse, you'll put all of their names there. So you're going to put the employee, then the spouse, then the children, and you're going to mark off what months they were covered for coverage. If they were covered for all 12 months, check the 12-month box. If it's a new employee and they were only covered for 4 months out of last year, you'll check the 4 months that they were covered. Any questions so far in 1095-C? And again, Sections 14 and Section 16, we're going to get into those two codes here in a little bit. All right, I'm going to go ahead and move forward. 1095-C Part 2, this is Section 14, the employee offer and coverage. Oh. Correct. So the question is, cost for employee only for dependents is the same for the dependents. So no matter what plan your employee is on, the number you're going to put in there is only going to be the employee-only premium. So if you have 5 employees who are employee-only and their premium is $439 a month, and you charge them $50 a month of that, you're going to put in that $50 amount. So it's what you're charging the employee for their employee-only premium. Their dependent costs don't matter. It's just what the employee is paying for employee-only premium. So again, with a lot of our groups, they offer the employee-only for free and then allow the employee to buy up to employee plus spouse, employee plus children, employee plus family. You would put 0 in that box because that's the cost to your employee. Your employee-only premium is 0. If you're charging per pay period and you have, say, 26 pay periods, so with like 26 pay periods, let me go back to that statement. With the 26 pay periods, you're going to take the amount per pay period, multiply it by 26, and divide it out by 12. Now the next question is, what if the employer offers benefit dollars? It's going to make it a little more difficult on you. When you go to look at the benefit dollars, you're going to need to see how many of those dollars were used for where. So if you offer your employee $500 a month in benefit dollars, and they have a $300 medical plan, and a $40 vision plan, and a $70 dental plan, if their benefit dollars cover all of their benefits, the employee-only premium is still going to be zero. If the employee-only premium has still a little bit left over, then whatever that difference is what you're going to be putting in there. But for the most part, what we've seen with benefit dollars, the benefit dollars tend to cover pretty much everything that the employee only has. So take your benefit dollars versus the employee-only premiums. If it covers the entire employee-only premiums, you'll be able to put a zero in there because the difference is going to be the cost of the dependents. Any other questions so far on that, our previous slide? Perfect. I'm going to move forward to the offer and coverage. So there's 9 different codes in this section. There's a few different things that can be used, a lot of things that won't be used, and a whole lot of confusion in here. Code 1A, minimum essential coverage, providing minimum value offered to full-time employee with employee contribution for self-only coverage equal to or less than 9.5% of the mainland single federal poverty line, and at least minimum essential coverage offered to spouse and dependents. What this means, if you have a plan that offers the employee-only premium for less than $93.17 per month, so you charge your employees $30 per pay period, you're going to be under the $93.17 per month, you can put 1A in Section 14 for all of your employees. And typically what we've done throughout the past few years is we have, or the past year I should say, is looked at your lowest paid employee and factored this at 9.5% of their income, and that's what everybody's costs are based off of. That way you have a safe harbor and you're not overcharging any of your employees. But if your, again, coverage is costing the employee only nothing, so for the employee, they're paying $0 per pay period, $0 per month for their employee-only coverage, you'd be able to use Code 1A in Box 14. And for a lot of folks, this will be the correct code, and they'll be able to use this because they're not charging so much to their employees. Now, the other caveat to this is to make sure that an employee can add their spouse and their dependents to the plan. So as long as they can offer coverage to spouses and dependents, it doesn't matter what the cost is, but as long as they can do it, then this code will work. Code 1B is minimal essential coverage providing minimum value only to the employee. So if your coverage is employee only, but provides that minimum essential coverage, which everyone's coverage does who's on the call, and you haven't offered coverage to dependents, then you can use Code 1B. 1C means your plan allows the employee only or the employee plus children without spouses allowed coverage. And that's going to allow you Code 1C. Any questions on these codes so far? Perfect. Now as we continue through, 1D is just going to continue down the line. This is coverage that's offered to the employee plus the spouse, but not the children. 1E, minimum essential coverage providing minimum essential value to employee and minimal essential coverage offered to dependents and spouse. Code 1E, I'm still waiting for more information on, because Code 1E is what you're going to use if your costs are more than the $94 per month to the employee. So if you're charging your employees $100 per month for them to get coverage, you'll use Code 1E. If you're charging less than that $93.17 per month, you're going to use Code 1A. Those are your two differences there. Now, 1G is an offer of coverage to an employee who was not a full-time employee for any month of the calendar year and enrolled in self-insured coverage for one or more months of the calendar year. So if you have a plan that's available, and in the case we do have several fire districts, and you offer it to your volunteers who are not technically employees, 1G is going to be the coverage code that you're going to use. 1H is going to be the coverage code that you'll use if you have a waiting period in place and your employee joined you, say, in November, and that waiting period took them to January of the following year. Then for November and December, it would be a 1H, no offer of coverage, and that's because the employee is still in their waiting period. Any questions so far on the codes that we've gone over? It's a lot of information to know for that Section 14, but the biggest things are that if your plan is charging less than $93 per month, 1F. So 1F, minimum essential coverage, not providing minimum value offered to employee and at least minimum essential coverage. So this is going to be, 1F is going to be if your plan costs more than 9.5% of your employee's gross household income for that year. And that's for employee-only coverage. So let's say you have an employee that makes $25,000 per year. That means per year you'd be able to charge that employee $2,375 or $197.91 per month. If you charge that employee $400 per month for their coverage, then you would hit number 1F. For most of our employees, you're not going to come anywhere near 1F. You're definitely going to be in that, you're going to have that value there for your employees. So the codes that most of the folks and everyone on the call are really going to be focused on, code 1A, which is the code for providing coverage that meets everything for Affordable Care Act and is less than 9.5% of the federal poverty level. Code 1E, which is if you're charging your employees more than that 9.5% of the federal poverty level or more than that 93.17. And potentially 1G, if you have folks who are not actually employees and they're enrolled in the coverage for one or more months. And 1H, if you have anybody who came in late at the end of the year and didn't have coverage, didn't have an offer of coverage yet because they were in a waiting period. Any other questions so far on what we've gone over? Let me go back. So 1G, offerage of coverage to an employee who is not a full-time employee for any month of the calendar year. Does that include retiree coverage is the question. Yes, it does. It could also include your COBRA coverage. So if you have employees who are out because of they no longer work for you, but they have enrolled in COBRA, code 1G will be used for that reason. or if you have retirees who are no longer employees, 1G will also be included for that coverage reason. Now, under COBRA and retiree coverage, you won't have to fill out the section 15 that asks for affordability information. How much did it cost them? You can skip that section because there's no affordability guidelines for that. I'm going to move on to the last code, 1L, qualifying offer transition relief for 2015. Employee and spouse or dependents received no offer of coverage, an offer that's not a qualifying offer, or a qualifying offer for less than 12 months. This would be if you had an employee on staff who was there for the full year, but for some reason did not get a qualifying offer of coverage, even though they were full-time. I don't know of any of our groups that are going to have to use this code. Unless there's been an employee that's been on staff who's been working full-time and you just forgot to offer them coverage. If you forgot to offer them coverage, you would use code 1L. But for the most part, everyone is going to use one of the other codes. So from here, what I'm going to do is move forward to the 4980H safe harbor codes and other relief, unless there's any other questions on the codes we've just gone over. All right, I'm going to go ahead and move forward. Section 4980 Safe Harbor Codes and Relief. Part 2, Question 16 of the 1095-C is where these will go, and only when one of the following situations applies. The employee was not the employer, was not a full-time employee. The employee enrolled in the minimum essential coverage offered. So for most everyone, that's where you're going to have to deal with this code. The employee was in a limited non-assessment period with respect to Section 4980H. That's basically your waiting period. There's a non-calendar year transition relief that has been applied to the employee. The employer met one of the Section 4980H affordability safe harbors with respect to this employee, or the employer was eligible for the multi-employer interim rule relied on for this employee. Now that last one, the multi-employer interim rule, this rule is designed for folks that have union employees and are forced to pay into a pool for union employee coverage. So if you have employees that are within a union and you have to pay into a pool for their health benefits, this is where that section comes in. So I'm going to go into all of this here in just a bit more detail on the different safe harbors and codes that are available. So the code you have, these are the two codes that go hand in hand with the one codes that go right underneath them. 2A, employee not employed during the month. Use this code if the employee is not employed on any day of the calendar month. And do not use this code for the month during which an employee terminates employment. So this is the code you're going to be using for retirees, COBRA, because with this code, these are folks who aren't actually employed by you anymore, but still are on your coverage. 2B, employee is not a full-time employee. You'll use this code if the employee is not a full-time employee for the month, or the employee did not enroll in minimum essential coverage, if offered for the month. An employee who is a full-time employee and whose offer of coverage ended before the last day of the month solely because the employee terminated employment during the month. Now, I should say, with these codes, it may not be that one code in the two section fits every single month. You may have 2B in December because that's when the employee left, and then other codes for the rest of the year because the employee was enrolled in coverage at the time that they were employed. And then as well for January 2015, if the employee was offered health coverage no later than the first day of the first payroll period that begins in January 2015, and the coverage offered was affordable and provided minimum value. For everyone on the call so far, your coverage provides minimum value and is considered affordable. So I'm going to move into the other codes so we can kind of see where things are going to get used and what additional codes we'll see. Code 2C, employee enrolled in coverage offered. Use this code for any month in which the employee enrolled in health coverage offered by the employer for each day of the month, regardless of whether any code in this code series, other than 2E, might also apply. Now the big thing here, you're not going to use this if you use code 1G. So for your retirees and your folks on COBRA, they're using that code 1G. You cannot use code 2C. These two would just fight each other. 2C says they're an employee, 1G says they are not. So just don't put these two codes together and you'll be fine. And it's code 2A for your COBRA retiree type coverage. And again, the big bold point at the bottom, for any month in which an employee enrolled in minimum essential coverage, code 2C is used to report enrollment instead of any other code that could also apply. So for most of your employees, well, pretty much for all of your employees who have accepted coverage, 2C is going to be the box you're going to be, is going to be the code you're going to be using in Section 16. Any questions on code 2C? (2D), employee in a Section 4980H limited non-assessment period. Use this code for any month during which an employee is in a limited non-assessment period for Section 4980HB. A limited non-assessment period is a period during which the applicable large employer will not be subject to a Section 4980H penalty for a full-time employee, regardless of whether that employee is offered health coverage during that period. If the employee is in an initial measurement period, use this code for the month and not code 2B. So again, this is the code for your new employees. If you have a 30 or 60-day waiting period, this is the code that would go in for those months the employee was waiting to get coverage. And we're going to go in just a second. Now, again, one thing to take a look at, if the applicable large employer is also eligible for the multi-employer relief for this employee for the month, enter code 2E and not code D. So if you are, again, have union employees that you have to pay into coverage for, so your employee is a union employee and their coverage is paid for by yourselves as the employee or employer, plus 4, 5, 6, 7, 8, 9, 10 other employers that all put money into a pool for them, then you're going to use 2D. I don't believe that applies to most of our groups, but if it does, we want to make sure that you know that it's there. And I'm going to move to the limited non-assessment period definitions, and these come straight from the IRS. This is all information that I will be sending to you a little bit later, but the long and short of this is that the employee is in their waiting period for coverage. So that's that period of time where you're testing the employee is testing you to see whether or not you're going to be a good fit. A lot of places don't give coverage during that time period. They want to make sure that employee is going to work for them, is going to stay for them, before they start offering them all the different benefits. So that's what these are. Same thing for if you have variable hour employees. Variable hour employees are the employees that kind of skirt the line between full-time and part-time, where they may be part-time for the first quarter of the year, and then your summer section and spring section of the year, they may be needed more often, and they're hitting more full-time numbers, or they're getting even overtime numbers, and then towards the winter again, they start to back down into the part-time numbers. For those employees, you can use what's known as a look-back measurement period. If you're using a look-back measurement period for last year, this is where this code is also going to apply for the entire year because that's when you're looking back to see if they fit into benefits. Any questions so far on this code and the limited non-assessment periods? For the folks who are on the call now, I don't believe this actually will apply to you. I don't believe either of you actually do have any variable hour employees that you'll have to deal with. Code 2E, multi-employer interim rule relief. Use this code for any month for which the employer or the multi-employer arrangement interim guidance applies for the employee, regardless of whether any other code in Code Series 2 applies. Big thing here, multi-employer arrangement interim guidance provides that an employer is treated as offering health coverage if the employer is required under a collective bargaining agreement to make contributions to a multi-employer plan that offers affordable, minimum value, self-only coverage and also offers coverage to the dependents. This code, if for some reason you have employees that fall under this, this is the code you should enter. Again, though, with the state of Arizona, there's not much in the way of unions out here, not much that I've seen so far in collective bargaining agreements, except potentially with teachers, universities, things of that nature. If it applies, definitely keep this information handy. If you don't have any basically union folks or folks that are under a collective bargaining agreement through multiple employers where you're all paying into their medical together, then this code is not going to apply to you. Any questions on 2E? The last few codes we're going to get into, 2F, Section 4980H Affordability Form, W-2 Safe Harbor. Use this code if the employer used the Form W-2 Wages Safe Harbor to determine eligibility. This safe harbor is based on the 9.5% of your employee's gross household income. So if you based your coverage on the lowest paid employee at 9.5% of their gross salary, and that's the amount that the employee has to pay, you can use this coverage code. For the bulk of our groups, you will be able to use this code if you would like, because your coverage is going to be considered affordable. The next code, 2G, you'll use this code if the employer used the federal poverty line to determine affordability for any months. So if your cost for your employee-only plan is less than that $93.17 or $93 and change that we had earlier, 2G is what you're going to put in there. So you'll be able to put 2G in for all 12 months that the employee was employed by you, and you'll have this safe harbor. Again, the big thing to remember is your employee has to be spending less than $93 per month in order for this to apply. Any questions on those two codes? Now code 2H, and this is where things get confusing. You have the W-2 safe harbor, and then you have the rate of pay safe harbor. They basically amount to about the same. To be considered affordable under the safe harbor, 9.56% of gross income for plan year 2015, or 9.66% of gross income for plan year 2016. So at our minimum wage right now, at roughly 8.25 an hour, at 40 hours a week, and actually let's do it at 30 hours a week because that's the minimum they have to work to be eligible for coverage, your employee is making $247.50 per week. Take that out over the year. It's $1,072.50 per month that the employee would make. That would mean that if your lowest paid employee makes minimum wage, you could not charge more than $102.53 per month in order to be under this safe harbor. Again, for most of our groups, they're charging their employees less than this amount. So you'll be able to use this code as well, 2H, if you want to use this instead of the federal poverty limit. So if you're charging them $99 or you're charging $100 per month, then you're going to be able to use section or safe harbor code 2H instead of the federal poverty limit code. Any questions on code 2H? So 2I is non-calendar year transition relief. It's basically certain conditions have to be met on this, and you have to have a non-calendar year plan that's maybe treated as offering minimum essential coverage that's affordable and provides minimum value for the months prior to the 2015 plan year. This is not a code anybody on the call is going to have to worry about. This is a very specific code to get into, and it's not easy to use. Stick with the safe harbors for pay or the safe harbors for the federal poverty limit if your coverage fits within them. So that brings us to the end of all the different codes and everything else. What I'm going to do is open up our Q&A session. If you have any questions, you'll be able to just dial in, and then I'll go ahead and grab the questions from you, and we'll go from there. So if you have a question, go ahead and dial *6, and that'll put you in the question queue, and we'll go through and try to answer those questions for you. And actually, I do have a question here that says, even if we're on a fiscal calendar year. Yep. Even if you're on a fiscal calendar year, if you can use one of the other safe harbors, such as the rate of pay safe harbor, the federal poverty limit safe harbor, the W-2 safe harbor, use one of those. They're going to be easier for you to figure out. It's going to be less for you to have to prove to the IRS that you actually fit within one of these other codes than if you can say, well, the employee makes $8.25 an hour. We charge them $100 a month. That's $2 less than what they should be paying to be considered affordable. And I know this was a lot of information today. It's a lot to figure out and a lot to have to deal with. We're hoping to provide you just with a little bit of insight on where things are going with 6055 and 6056. The big things to remember from today: if you've got over 50 employees or you're on a self-funded plan, or even both, and yes, the presentation will be available as a reference. I will be combining the audio recording with the slides, creating a video, and we will upload that to our Benefit Logic YouTube page. But the big thing to remember is that Section 6056 is what the employer is going to be required to do. There's several codes in there that you'll be able to use, but for the most part, you're going to be having offered coverage for the full year, and your coverage is going to be considered affordable as long as you're not charging more than 9.5% of the employee's gross salary for employee-only coverage. But unless there are any questions, and I don't see any as of yet, I can go ahead and let you folks go for the day. I really do appreciate your time today, and if you have any questions, feel free to give us a call, and we'll try to go over everything with you. We do have another webinar at 1 o'clock. It's the same login information that you were given before. So if you want to jump into that one and go through this again, please feel free. There may be some additional questions that were not asked now that may be included then. Other than that, thank you very much for joining me. You folks have a wonderful afternoon.